All right, it's 11 and we're going to get started. My name is Trent Zimmermann, and I'm the Director of Annuities here at BGA Insurance. BGA Insurance is a GA wholesaler working with independently licensed insurance agents, financial planners, CFPs, RAs, you name it, on wholesaling life insurance, annuities, long-term care, and disability insurance. I myself have a bachelor's with a background in economics, a master's in finance. I'm a chartered financial consultant and chartered life underwriter. And this week we're going to be talking about buying income and investing the rest. Before we do that, a few stories. One is I like the phrase you get what you measure. So let's say you want to get healthy, you want to get in shape, and you say you want to get as strong as you possibly can. You can go way overboard and just optimize for building muscle, and you can work out as much as you can until you can't move your arms and legs anymore. And you keep doing that, you're probably going to get injured. You're definitely going to degrade your muscles, and you're going to realize at some point, okay, I need to eat and I need to rest. And so you're going to realize I need to eat a lot in order to build muscle, and I need to rest a lot to build muscle. And then hopefully sometime you'll build muscle and you realize, oh, I've actually put on a lot of fat with this as well. So my weight to strength ratio isn't that great. My cardio is not great. I'm wheezing walking upstairs and I can't touch my toes. And so you say, okay, I'm going to add in a little bit of cardio. I'm not going to eat as many calories. I'm just going to optimize for protein. And I'm going to stretch, that. And then you get to the point where you feel like I'm as strong as I want to be. I'm living the life I want. And you're realizing that when you were just looking at one single factor, you weren't getting the results you wanted, even though that's what you thought you wanted. And the reason I bring this up is because I've had a lot of conversations recently about people getting inheritances and the family trying to control it because they think they're going to blow the money. That person might not have heirs. They want to make sure that they're not taking care of this person later in life. And so they say, well, let's put a little bit in annuity to keep it safe. But then we want everything to just grow as much as possible. And when we run the analysis, is that has a really low chance of success. And if we increase the annuity amount, we can increase the amount that stays until they pass and make sure that it's less likely uh, to be depleted. And all this to say is what you measure is what you get. And oftentimes I hear a lot about growth. And when you're optimizing only for growth, you're not going to get the results you want for income in retirement, which is what we need. And we know this. We all know this. That's why no one's doing, 100% in NVIDIA to fund their retirement. Even if you're saying, oh, it's all assets under management, you're putting a hedge into bonds and treasuries. You're doing the standard 60/40 blend. So these uh this is all how we are designing these is to have these hedges. And so I believe that we need to introduce annuities into that mix. And just because they don't have the growth potential doesn't mean that that won't improve the growth of your portfolio as a whole. Uh, because just because you're not controlling, uh, sorry, one second. Okay. Just because we're not optimizing for the maximum amount of growth doesn't mean we aren't optimizing for the growth long term. Like going back to that exercise example, that you have to eat, you have to rest, you have to take care of your body in order to get what you want as a result. So, if you've been on these before, you've seen this slide. There is a number. This is some of our retirement software here, just a clip of that you invest a certain amount of your portfolio into annuity where you're going to never outlive your money. Your core expenses are covered. Chance in a Monte Carlo analysis, you can look that up in your own time if you don't know it. I won't bore you with the details of portfolio depletion is less than 1%. Over 75% of historical backtests showed that you have a greater terminal portfolio size. The size of the money you have in your portfolio at death is larger with an annuity than without, and you've eliminated your core concerns. The research backed this up. I have five Nobel laureates listed here. Actually, six because we have Daniel Kahneman and Amos Tversky who share one. But bubbles are only obvious after the fact, according to Eugene Fama. William Sharpe, market timing is impossible. Daniel Kahneman and Amos Tversky, we have a disproportionate sense of loss versus hope of gain. Uh, Paul Samuelson, staying invested leads to the best gains. And Robert Schiller, our psychology leads us to buy high and sell low. And all these talk about the benefits of annuities in negating those risks and leading to better results. Harry Markowitz, the creator of modern portfolio theory, wrote that it was never designed for individual households. It was designed for large institutions with indefinite lifespans. And rather for the individual, we should be matching the risk and cash flow profile with the assets and liabilities needed to achieve that. The consensus from all these researchers is that annuities often outperform retail investors because it removes loss aversion and reactivity. Now, if you've seen another slide that I like to put up a lot, that the return of FIAs, good, bad, ugly, volatility control, equities, has been at 6.88 according to LIMRA, whereas the stock market has a historical return of 10.44. There's researchers that will say if you're not accounting for the effect of compounding and we're looking at just real annual returns, getting rid of fees and taxes, that looks closer to 7%. But the return of a FIA is lower than that. So we're not going to promise that an FIA is going to outperform. But because of the psychology of retail investors, they often do. So buying income allows you to take more risk and staying invested longer. It ensures for longevity. And that insuring for longevity actually tends to lead to longevity because you have less stress on you and you have the cash flow to take care of yourself. You don't feel bad pulling money out of your portfolio to take care of yourself because you know you have a cash flow. And sequence of return risk is greater than we give it credit for because it's unpredictable. So let's put your money where your mouth is. Ken Fisher, the guy at Fisher Investments who says, I hate annuities, himself owns annuities and invests in companies that specialize in annuities. Warren Buffett has two rules of annuities. It's insane to risk what you have for something you don't need. Why optimize for growth and try and get the most growth as possible and put that money all at risk when you need it to retire? And now is the right time to take some cream off the top. You have been invested in the market for a long time. I would never suggest an annuity for somebody in their 30s and 40s, maybe even their 50s, depending on when their retirement is. But why not take some money off the top now? You've had all that gain, you've had all that time for growth, and allow yourself to recover from any downturns. Take some money off the top. And BlackRock recently released Psychology Investing, how advisors can support their clients. And it talks about all the stuff we talked about, loss aversion, action bias, FOMO. And so let's talk about sequence of return risk before we even go into buying income. This is looking at the same time periods, just flipped, so that you can have, in the end, the same average return, but you see how the sequence can drastically affect. So we're looking at the first one, 1998 to 2024. Mr. Red finishes with 1.2 million. Mr. Green finishes with 3.5, essentially. In 2020 to 2024, Mr. Red runs out of money at 79, and Mr. Green has 2.385 at 85. Sequence of return is huge, and that doesn't even factor in RMDs that are going to start at 73. And if we go back to volatility drag, we can see here the disproportionate amount of gain you need to make up losses. So if you're taking income and you're taking 4%, which is the safe money, and you have a 20% down year, and you're in assets under management, that's another 1% loss. You're now looking at 25% loss, and you're going to need to make up 33% for a 20% down year. That's a big gain. How many times has the market done that? So that gets us to it takes two. Takes AUM and it takes annuity. So if the safe payout for AUM is 4%, and even then you might run out of money if you have bad sequence of return, why wouldn't you have some money in an annuity that is going to guarantee 6 to 12% growth in roll up, not in account value, and guarantee a payout of 7 to 8.5%, maybe even higher, maybe 9, depending if you're letting it defer for some time. Some even go up to 10 if you're deferring for the right amount. So, more retirement theory, uh, because of this, it takes two, from Jason Branning and academic Ray Grubbs, talk about building a pyramid. You have your essential needs, contingency fund, discretionary expenses, and then legacy fund. And no money flows up the pyramid, or in this case, down the numbers, until the level below is fully funded. So now we're getting to more than it just takes two, but you'll see where this develops. So they go through the steps to find the income floor. Housing, what's the cost of mortgage, rent, taxes, insurance, maintenance, food and groceries, healthcare, utilities, transportation, minimum debt payments, and then subtract all existing guaranteed income. Of course, that includes Social Security, that includes pension if they have one, any existing annuities. Buy that income. Buy a single premium immediate annuity, buy a deferred annuity to close gap. That's what they say. FIAs are more competitive right now for immediate income than SPIAs, just with how the rates are working. If you're looking at roll up, they tend to be better and have better benefits as well and more flexibility. But right now I'm just quoting them. And invest the rest. With the income floor secured, the remaining portfolio is now truly risk money. It can be invested more aggressively, because they know in down year they can just live on their basic expenses. They don't have to pull from this if they don't need to. And they have permission to spend from this investment portfolio for discretionary items. So the typical allocation for the rest, according to these two, Banning and I'm blanking on his name. Banning and Grubbs. Thank you. We're looking at higher equity exposure. 7% on the low end, 100% on the high end, and depends on their stage of life, of course. And this is rational since you don't need to protect as much. Very different from the 60-40 split that you would see if you're pulling at 4%. And this can include some riskier bets like real estate, REITs, international equities. This is all growth focused. This is your growth bucket. And it's spending on stuff that you don't necessarily need to be spending on, vacations and gifting. And then later in life, you can dedicate it towards stuff you do need to be spending on, healthcare. And so the argument here is I could hedge, I could reduce some of this risk with treasury and bonds. You could, but when we're looking back at 2020s, we did see a 50% dip in the price of those. If you wait till maturity, of course, you're going to get your interest back. But if you got to sell in a down year, what if stocks and bonds are moving in the same direction like they have been these last 10 years? And now both are down. You don't have that hedge anymore. And so if we look at some research by Jeremy Siegel, stocks have been the most consistent upward trend in our economy, in assets that you can buy, and well outperforms the dollar, gold, bills, bonds, outpaces inflation. But that's on a long-term view. In a short-term view, it is more volatile than any of these other ones except for maybe gold. So you want to be in that risk bucket longer. You don't want that risk bucket to be your short-term spending. Morgan Stanley did a study on this, 10-year global investment office study, and found that portfolios with annuity allocations, they did not control for strategies, allocation sizes, whether it was a SPIA or an FIA, they control for none of that. Just, do you have an annuity in your portfolio that is paying income? They had 19% higher probability of sustaining income over a 30-year retirement. Of course, you can't talk about depleting asset or depleting to zero because that's not going to happen with an annuity. But if you need $100,000 to live, do you at any time have to reduce that because you have an annuity? No, less likely to, about 20%. And we're looking at the bottom quartile of people, the worst case scenarios, the bottom fourth of scenarios. People who had an annuity that was paying income had 10% higher terminal wealth. The money they had at death that they could pass on to the heirs was 10% higher. So their key benefits were it solves the number one retirement fear of outliving money, eliminates sequence of return risk for essentials. They had permission to spend. They weren't underspending in these years. And they had a simplification of asset management. So we've talked about different ways of structuring these. This is the retirement smile. The best way that they say to do it and that Banning and Grubb say to do it is fund this dotted line, the constant inflation adjusted spending. Because you're going to have a decline in non-health spending as you slow down, and later in life you'll have a increase in health spending. And if you can fund that top line, you're going to be set for life. But not everyone can. Here's some research from Blanchett describing that. Some people can only afford to fund the bottom end. And that's okay. There's strategies that you can hedge on that risk bucket to, again, return back to the 4% rule to be able to fund that. And there's variations on this even further. None of these defined this is the clear winner strategy. They're all just looking at annuities in general. There's a Social Security bridge that you buy a 5 to 7 year period certain annuity to delay claiming Social Security till 70. That increases the benefits by about 77%. And then you're increasing that guaranteed income floor. That now you're funding less with an annuity because the government program is paying you a higher floor. There's annuity laddering that, let's say we're going back to that last example, you can't afford to hit that high line, so you're gonna just fund the lowest level of expenses here. But later in life, you'll tick up. You'll have other annuities that will deploy. You'll de-risk some of your portfolio, put it into an income annuity, and keep chipping up that income over time in a way that you can afford. There's qualified longevity annuity contracts that you can take 200,000. That's an old number. I think it's 210,000 now, from a traditional IRA or 401k. And now you're not owing RMDs on that. And you have until 85. You can deploy to 85. Yeah, there's also the retirement distribution hatchet that you can live off of some of your invested money for the first couple of years while you let the roll up catch up, and then have that income take over. Or there's this strategy of what we talked about before for that low level. And I should have put this slide earlier. That you're chunking up your income over time. So I'm going to end on this. This is a strategy that Banning and Grubbs came up with. So I said that it takes two. They say it takes four. So income protection, you get an FIA, a SPIA, a DIA, cover your necessary expenses. You have an inflationary hedge time segmentation in a portfolio where you're periodically de-risking, making sure you're taking money out of your sequence of return risk so that you have it there for medical expenses, for some extra income that you might need, for discretionary spending that you have on the side, so you don't have to pull down in down years. You have a risk wrapper. They say cash accumulation IUL. If you joined last week, we talked about buffered assets. It can be a plethora of buffered assets, but cash accumulation IUL is good because you can pay over time where you can't in an annuity. It's going to be a lump sum. And it will pass off as a tax-free death benefit if you don't need it, which hopefully you don't. But this risk wrapper is if you really have a need for a lot of money in a down year, and that's going to cause adverse effects on your portfolio, you can pull money out of that in a loan. It will be a tax-free loan that you pull off against the IUL in order to fund those costs. You can pay it back. You can hope for a loan arbitrage if it's an overfunded IUL. I'm not going to get into that. You can talk to any of our experts here about that who are more versed in that than I am. And then you have total return, that you have a classic portfolio that you're invested in equities and looking for growth. Brings us back to this point. There is a number that you never outlive your money. Core expenses are covered. The chance in a Monte Carlo analysis of portfolio depletion is less than 1%. You're going to have a greater portfolio size at the end with annuity. You eliminate core concerns. Now, we've done our own look at this and said, what's holding people back? And a lot of times it's the fear that you are going to be losing out on your own income by investing into these. And I've tried many different ways to look at this and control for that lower amount in assets under management, but higher amount in commission. And there are commission structures that you can pay yourself 1% on these annuities for the life of the annuity that make that money back up. And at the end of the day, from our attempts at doing Monte Carlo analysis, we found that the average cases or average individual income in your pocket at the end of the day is the same, almost the same. The upside is much better with an annuity because you got that large commission and their portfolio has grown exponentially. And the downside is not as big, that they're not going to have that portfolio depletion, and now you have no assets under management. That has become much smaller. The average tends to be about the same. So the question for you is, are you willing to cover your clients' core expenses, reduce their concerns, increase their longevity, increase their terminal portfolio size, and make, on average, the same amount of money? And in good cases, if that's the average, 50% of cases are going to be much better. And in 50% that are worse, your risk isn't as large. It's never going to go to zero. So we're stepping away from it takes one. We're stepping away from it takes two. We're talking about this RISA plan, and that's now it takes four. And there's a lot we can work with you on that. Give me a call, send me an email if you want any of this information. I'm happy to send it to you. I know we went 3 minutes over. We have a fact finder. If you want that to collect the information, we can put it into our retirement analysis softwares and give you the chance of them having success with this. But with that, that's your 20 minutes. Actually, that's your 24 minutes. I apologize. If you have any questions, feel free to stay on. I'm going to launch the poll for next week's topic that you guys can vote on, and feel free to unmute or drop a question in the chat if you have any. So in case you want to hear some explanation, AUM protection plan is just going into this more about how you're protecting your assets under management. Rolling over annuities, there's a massive wave, the biggest we've seen of annuities coming out of surrender since we had the rate increase 3 years ago. What do you do next now that they're a surrender? turn qualified funds into long-term care. Normally, you can't use qualified funds for long-term care. There are strategies around that. The RISM deep dive we talked about, it takes 4. We can talk about that more in a deep dive, an asset-based long-term care deep dive. We did long-term care, but it was a very broad overview. We can dial in on annuities and hybrid long-term care. But looks like you all are done voting. So we're going to do turn qualified funds into long-term care. It's a great strategy. Looking forward to talking about it with you guys. And that's all I've got for you. I'll stay on for a few minutes longer if anyone has any questions.